I'm tracking the 50 best stocks in the stock market, and right now I see 3 stocks that are winning hard despite all the market drama, and they're now trading at a pretty massive discount because of this recent dip. So the first stock of the 3 winners is called AST SpaceMobile, and I wanted to go over this one first, because if there was only one stock I could own for the coming 5 years, it would be this one. Most people would say something like Meta or Amazon, but this company has so much potential and comes with very little risk. If we head over to the AST SpaceMobile tab, you can see all the earnings for the coming 3 years, and I even modeled them out for the years 2029 and 2030. So for an expected 140% revenue growth rate in 2028, a PE ratio between 100 and 200 is more than likely. Then the stock price will surge between 116% and in the bullish scenario 330%. And this is not taking into account the future possible government contracts or new potential partnerships. And now I will tell you why there's so little risk with investing in this company. So first of all, what this company basically does is put satellites into space to deliver 5G internet directly to your cell phone. So if you compare it to Starlink, the company of Elon Musk, where you have to buy a router to receive data, AST SpaceMobile will directly connect to your cell phone. So a much better and efficient technology. And they're 5 years ahead to their closest competition. And let's say competition will start to work on a similar technology. This company has 3,500 patents. On top of that, they have more than 50 telecom partnerships, which is massive. Right now they have 5 working satellites in space. And I can hear you think right now, only 5 satellites, that's nothing compared to Elon Musk that has hundreds of satellites already in space. Well, first of all, the satellites are much bigger of AST SpaceMobile. They're the same size as a basketball court, and they are able to cover much more ground. With only 250 satellites, they can cover the whole world. Their goal is to have 50 to 60 satellites by the end of the first quarter of 2026, which is very soon. Their second goal is to have 100 satellites before 2027 begins, and their goal for 2028 is to have 243 satellites, providing basically global coverage. And they're projecting to generate $5 billion in revenues annually by 2030. And that's exactly what you saw in my calculations. And by the way, I'm not inventing these numbers. These are coming from analysts and the company their own guidance. Furthermore, they have a very strong balance sheet with $870 million in cash. So basically, investing in AST SpaceMobile is a once-in-a-generation opportunity to invest in a company that is building an entirely new infrastructure to connect billions of people globally through satellites. The next stock of the 3 winning companies is called EOS. And this stock has even more potential upside compared to AST SpaceMobile, but it comes with a little bit more risk. At least that's what analysts are saying. And if you look at EOS numbers, you can see that it will grow from 150 million in revenues in 2025 to $1.4 billion in 2028. As you can see in the year-over-year growth rates, it's literally skyrocketing. Same counts for the EPS, and the outlook for 2029 and 2030 is also looking relatively positive. So I would say for a revenue growth rate of 60% in 2028, a PE ratio of 60 to 80 is 100% reasonable, and that means that the stock price will surge between 400% and almost 600% in less than 3 years. Now, what this company is making is truly spectacular, and in my opinion, this is probably the best stock in the stock market right now. So what this company does is revolutionizing the battery industry by making zinc batteries instead of lithium batteries, which have 2 times the energy density. These batteries are much safer in terms of catching fire and in terms of chemical substances. Furthermore, they are 100% recyclable, non-toxic, and they can operate in extreme temperatures, which is needed for a lot of businesses. It almost sounds fake how good this technology is, but the story will get even better. But first, smash the like button, I would truly appreciate that, and only subscribe if you want to see more videos of me. Alright, so their zinc batteries don't need any cooling systems, which you do need in lithium batteries, and because of this, they can be produced much cheaper. On top of that, it's not a rare earth mineral, so they're not dependent of China, and rare earth minerals are obviously much more expensive, and the products of this company is 90% made in the US. And listen here, if I was Trump, I would definitely like that about this company, and it also turns out to be like that, because this company is receiving 90 million annually in subsidies. On top of that, they got a 400 million loan from the government, because the government wants to support companies that are making the United States more independent from other countries like China, and so they can solve the energy crisis that we're heading towards. EOS also got 650 million in backlog, which is a fancy way of saying future secured revenue. If we look back at the Excel sheet, right now they're only generating 150 million annually, so 650 million secured revenue for in the future is a lot. Apart from that, this company has multiple powerful tailwinds, which one of them is the data center boom. Right now the data center revenue is 22% of their business, and it's growing at a very fast rate. They're right now in a 200 billion addressable market, and this company is 4 years ahead of competition vision and it's very hard to replicate. You will need years of research and experience. And last but not least, they have a 22 billion pipeline, which means potential future projects, contracts, or revenues, which haven't been confirmed yet. And these two companies are one of my biggest positions in my portfolio because I like the numbers and I definitely like the story behind the company. Now, before we head to the third winning stock of the 5, I want to let you know that this spreadsheet, where you will be able to track basically the 50 best stocks in the stock market, where you will be able to see the future growth rates, the potential upside over 3 years, how risky they are, the sector that they are in, when their next earnings report is, and how many days you still have to wait for the earnings. All of this is available on my spreadsheet, and I will soon make sure my spreadsheet is available for everyone, at least every one of my YouTube members. So this way you know which stocks are the hottest right now and got the most potential. And this can literally make or break your portfolio. In the last 2 years, my portfolio surged 240%. So it's definitely helping me a lot. And I want to share this with the people that are willing to pay for the hours that I put into this work. So the third winning stock is called Meta. This company won't have that insane returns as the previous two companies. But if you look at the spreadsheet, Meta will still have a 97% return over the coming 3 years. And it's pretty low risk. Now if we head over to the Meta tab and take a look at their numbers, according to analysts, they will be growing on average, let's say 15%. And here you see their EPS numbers. And if we give Meta a PE ratio between 25 and 35, then the stock price of this company will surge between 50% and 113%. To be fair, a PE ratio of 25 with these growth rates is very unlikely. So I would look more towards the 30 and 35 PE ratio. And then if we take the average, the stock price will basically double. And the more insane thing about this company is that the stock price really crashed with their latest earnings release, dropping basically 20% from their all-time highs. Well, their numbers were phenomenal. The only two things that were not great is that they had a one-off tax payment, which reduced their profitability by a lot. So that's why they missed on their EPS guidance. And people are a little bit conscious about the insane capex spend of Meta, which I could see why, but I have to agree with Mark Zuckerberg. It's better to spend more aggressively on talent, data centers, and AI than miss out on this massive AI opportunity. And right now, Meta has a ton of cash and they're generating a ton of cash. So I don't see why Mark Zuckerberg shouldn't do this. So they're working on their LLM model, which is growing the fastest compared to all the LLM models out there. Now sitting at the third place behind OpenAI and Gemini. And the great thing is that Meta has a ton of pricing power compared to OpenAI, and this allows them to make much cheaper and more attractive deals, which forces Sam Altman to burn money. So I can definitely see their Llama model growing a lot. And they have a relatively new fast growing business, which is called Threads. It's right now 1/3 of the size of X, also known as Twitter from Elon Musk. And they did that in just 16 months. And Threads is expected to generate $2 billion in 2026 and $9 billion in 2027. Now if you look at their total numbers, that's basically 5% of their total revenues, but it's still a nice and fast growing business. And the untapped opportunity right now is WhatsApp with the business messaging and potential ads, which can make sure Meta will be growing their revenues even faster than we all expect. And they haven't really started the monetization of that platform. And it's basically just the best advertising place in the whole world, and that makes this company such an easy buy and a hold forever. So Meta is a great play if you want a cheap Max 7 company with still very decent growth rates. Now do me a favor and smash that like button, and I would suggest watching this video, where I definitely shared some hidden gems in the stock market.